stock markets in the United States hit a bit of a rough patch this week, and when markets hesitate like this and pull back, investors place more emphasis on defensive companies, which Coca-Cola can be considered one of those. It's a dividend-paying company, and it's a habitual product, and so consumers will likely continue purchasing Coca-Cola products despite macroeconomic headwinds. Also, Coca-Cola's business provides insights into consumer behavior, and given the rapidly changing macroeconomic conditions with increasing geopolitical tension and increase in trade barriers, investors want to know what's going on with Coca-Cola stock. I'll answer those questions here in this video, share with you my proprietary discounted cash flow valuation model, which calculates a fair value for Coca-Cola stock, and answer whether or not I think Coca-Cola stock is a buy at current market prices. You're not going to want to miss these details. Let's jump in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Coca-Cola's management team said that volume declined 1% during its most recently completed quarter as they cycled a different comparison compared to the last year. Remember, Coca-Cola benefited during the economic reopening as people unleashed pent-up demand to go out of their homes. Coca-Cola has a larger market share when people purchase beverages outside of their homes. This means when people go to restaurants, theme parks, concerts, sporting events, movie theaters, etc., they're more likely to purchase a Coca-Cola beverage compared to a beverage from one of its competitors. And so as people spent more time away from home following the economic reopening, a lot more than usual even, that allowed Coca-Cola to benefit from that trend, from that above average market share. The management team also said that several markets were weaker in the first quarter, improved volume sequentially, including the US and Europe. In these markets, the plans they've implemented are working, providing further confidence we can influence the trajectory of our results. And that's important. When management feels confident that they can influence the trajectory of their results, they can reduce the riskiness of the business. What that means is they have actions they can take to change consumer purchase behavior. They can maybe have a lower price in a certain market and that can increase sales. They can maybe increase advertising in a certain market and that can increase sales. They can maybe introduce a new product packaging that can increase sales. So they can feel confident that they can make some changes to make results better than otherwise might be. They delivered 5% organic revenue growth and robust margin expansion, which led to 4% increase in earnings per share despite headwinds. More broadly, they feel confident about the industry. 5% organic revenue growth for Coca-Cola stock investors would be great. The company usually generates profit growth ahead of revenue growth, but because of the increase in cost, this quarter was a unique quarter where the company didn't generate an increase in earnings per share above that of its organic revenue. But usually you'll see the company generate earnings per share growth at roughly 2 times the rate of its organic revenue growth. But the company doesn't usually generate 5% organic revenue growth. Lower single-digit revenue growth organic is what investors can expect from Coca-Cola in the long term. But in certain situations, the company might experience better revenue growth. By the way, this document I'm reading from is Coca-Cola's second quarter 2025 earnings call with Wall Street analysts. I've made this highlighted document available to my channel members. You go to your membership benefits section on my YouTube channel page, where you can access the link to the file that contains this document, as well as dozens more highlighted earnings call transcript for many other companies. You can join our channel for less than $5 a month. See the link in the description for all the benefits you get. This is only one of the benefits you get for joining our channel. So they also said that in North America, while volume improved sequentially, it declined due to the continued uncertainty and pressure on some socioeconomic segments of consumers. So this is a politically correct way for Coca-Cola to say that lower income households are facing more pressure and they're purchasing less product. And that's true across the board when I look at companies including Chipotle, McDonald's, Coca-Cola, Pepsi-Cola. Across the board, lower income consumers are facing more pressure. Lower income consumers are the ones that are going to feel the most pain as a result of tariffs because a larger percentage of their income goes towards products that will be impacted by tariffs. And despite what the administration says, the tariffs are paid by U.S. businesses, and then U.S. businesses choose what to do as a result of their higher cost. They can choose to absorb those higher costs, or they can choose to raise prices, and then consumers have to pay those higher prices or make a choice to switch to another product that may not be as high a price. But since nearly every business is facing these tariffs, nearly every business, in my opinion, will choose to raise prices in some degree to some level, whether it be 5%, 10%, 15%, 20% remains to be seen. But if businesses don't raise prices, they will absorb those higher costs and their profit margins will shrink. So you can reasonably expect businesses to raise prices going forward, and lower income households will face the brunt of those higher prices, which will hit them harder than it will hit higher income households. The company continues to invest behind their brands, which led to value share gains and revenue and profit growth. Their price mix decelerated as growth from some of their premium brands moderated during the quarter. So, to support these higher prices, Coca-Cola will be investing in more marketing and advertising because people will see higher prices, and that will create a sort of, a snapback when people go to the grocery store and see, hey, I used to pay this much for this product and now I have to pay that much. It is a bit of a shock. I still remember when I was a kid walking down to my local grocery store because it was walking distance from my house. I could buy a 2-liter bottle of soda sometimes on sale for 69 cents. Nowadays, I'm lucky to see these 2-liter bottles of soda selling for $2 or $2.50. They're usually $3 for the 2-liter bottle of soda, as these prices have consistently increased over the decades. So now that we've got an idea of what's been going on with Coca-Cola lately, let's look at valuation. My intrinsic value per share calculation, my proprietary model here, has this business worth $107 per share. The current market price is only $71. So Coca-Cola stocks looks undervalued primarily because of the company's lower beta. And remember, beta is a measurement of risk. And since Coca-Cola stock is less risky than the average stock in the market, the discount rate applied is much lower than the average stock in the market. In fact, the weighted average cost of capital is just 6.8% for Coca-Cola. As I mentioned, it's a relatively defensive company. People are likely to continue purchasing Coca-Cola more so than purchasing a product like, for instance, booking a trip on Airbnb if their incomes face pressure. And so its business holds up relatively well amid a macroeconomic backdrop that's slowing. The business might experience a decrease in purchases from lower income households, but that will be offset by more purchases from higher income households that are trading down from, let's say, purchasing a beverage from Starbucks. They might trade down and say, you know what, let's buy some Coca-Cola instead. And that can be the beverage we enjoy during the summer instead of going to Starbucks and buying a cold beverage from Starbucks. And so the declines from lower income households are offset by increases from higher income households. And overall, Coca-Cola's business remains relatively stable even during difficult economic circumstances. So to update my recommendation on Coca-Cola stock, I reiterated my buy rating today, August 20th. I think this stock is a buy for long-term investors.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.